Is the stock market going higher because of money printing? In this video, I'm going to break down some of the data as to why the stock market might be going higher or it might be going a bit more higher because of money printing. Remember, this is according to my own research. It's based on my personal views and data that I've collected. If you do want to keep up to date with markets, I do have a free newsletter. Link to that will be in the description. So look, the 16-year bull market that the stock market has been in. So this is talking about the S&P here. So I've covered this in previous videos, but the 12, 21 monthly moving averages have been bullish since July 2010. So since July 2010, the S&P has been the longest bull market in modern day history. And the timing of this is actually after when the banks were bailed out. So before 2008, the Fed balance sheet was around 900 billion, and then the decision to bail out the financial system, rather than let, institutions, fail, changed everything, right? So debt has spiraled out of control. It's not looking good for governments longer term from a debt perspective, and you could argue that because of this bailout, that was mainly one of the reasons. So in between 2000 and 2009, the decade produced negative returns despite a 10% long-term average, right? So two major crashes, the dot-com bust and 2008, compressed within the same decade, which led to the lost decade, as people like to refer to it. But since 2009, the average return has been roughly 11 to 12%, so nearly 17 years of consistent compounded return. Obviously, it's not been up every year. You've had drawdowns in between, but the stock market has been performing really well since that bailout in 2008. And look, the data. So 3 periods tell the story. So we've got some data here. So the stock market has performed 2% better during that time period. So since 2009, it's been 12%, and before then, for 80 years or so, it was around 10%. And in that lost decade, it was negative returns. So as you can see here, that the stock market has done better. So people saying that the stock market is only going high because of money printing, well, this proves it in some, to some extent. But it's going to be really interesting. We have had massive advancements in technology during that time period, so you can make that argument as well. But you could also say we did in the lost decade as well. So really interesting to look at that the stock market has actually had much better returns, or not much better, but 2% is like a 20% increase on 10%, if that makes sense, because it's 2% more. It is pretty big. So it's not like a marginal gain, it's actually quite a bit relative to that 10%, if that makes sense. So lower rates push capital into risk assets. So at zero interest rates, there is nowhere else to put capital. So cash earns nothing, government bonds earn nothing. People don't want government bonds. Obviously, that's a whole different story. We're going to talk about that stuff. The investor who needs a return is focused on an equity curve which is further, which equities do offer. So this is the same dynamic that drove REITs and real estate higher. You've seen REITs go up, and you've seen real estate prices from that. I mean, they might be coming down a bit now, but during then, obviously, property has gone up loads. 40% of 14 years of near 0% interest rates created 14 years of capital forced into equities, and we had 0% interest rates in COVID, or in and around that COVID time, and that's obviously never happened before. So we had this kind of low rates environment, so people were looking for returns, and that came into equities. People were able to take more risk because the safer stuff wasn't returning stuff. And you have examples for the likes of Michael Howe, who he talks about when he worked at Salomon Brothers. There was a textbook, 0% interest rates was never in the textbook until then. Darius Dale, the CEO of 42 Macro, he changed government bonds to gold. So those are some people at a really high level who are also doing those things as well. And 2022 test confirms it. When rates rose, the markets fell. So they did massive interest rate increases, and the markets did fall. So you could argue that the interest rates being much lower, since they do have a factor to play. And then we've got the chart. So as you can see here, we were a lot higher during that period. And we have been coming down, but during that time period, it's just been very low. You had obviously 2008 in and around this area, and then you've just had extremely low interest rates, and obviously they are high now. This is based off the interest rates in the US. You can find the chart on TradingView. So as you can see here, we've had low interest rates. I mean, they've come up a bit here, But in this period, they were little to nothing. But if they come up here, be interested to see what does happen. But I thought that'd be worthwhile, putting in, and you can look at the chart yourself on TradingView. So the case that money printing is driving it. So you've got 2008, so you've got the Fed balance sheet increasing to 2.2 trillion in a very short period of time. 2020, the COVID crisis. You had 0% interest rates. The Fed doubled its balance sheet, new highs within the year, which is just crazy. Every dip since 2009, especially on the S&P, has just been a dip to buy. And QE goes to financial assets before it goes to the real economy. So you do hear about this thing as well, about the Wall Street's winning, but the real economy isn't. And that kind of linked to the K-shaped economy as well. So you have Wall Street and people who have ownership and they own their assets, they're really winning. It's the best time to be alive for them. People who don't have so much ownership, they're struggling because of inflation and all those other factors. So those are kind of the main points. But the stock market is also a discounting mechanism. So this is really interesting to put in. So the index, will discount the bad companies and put in newer ones. I remember when MicroStrategy got put in, people were kicking off, and there were some other crypto things at the time. I can't remember off the top of my head, but MicroStrategy was a good example. They had the market cap, they had fit the criteria, they went through the system, and then they were in, and people weren't very happy. But the bad companies will get taken out, and the good companies will go in, and it's like a weighing machine, you could say. So, I've got a couple of points there, but, you cannot cleanly separate liquidity from fundamental improvement. So, it's obviously interesting to say like both have been happening at the same time. So, it's quite difficult to, I guess, separate them, if that makes sense. But it's worth mentioning that the stock market is a discounting mechanism. So, the bad companies will go, the good companies will get put in. The verdict. The monthly moving averages have been bullish since July 2010. And that is 16 years. It's a long time. And zero rates for 14 years, or very low interest rates, according to that chart, does show that people want to be taking risks. The government bonds aren't going to make money. Interest rate accounts are going to be losing the money, I guess if you factor in inflation. So people do want to take that risk. And the market is also a discount mechanism. Bad companies left, good companies grow. So liquidity created the conditions for that, but the index will always just discount the bad companies. So you've got both factors in play. So yeah, look, if you want to keep up to date with markets and learn more about this stuff and what I'm thinking, I do have a free newsletter. Link to that will be in the description. See you in the next one.